Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friends, Sam Clement and Courtney Tross. Y'all say hello.
How's it going?
Hey, John.
Hey, listen, it's going great. I wish I could say the same for the markets thus far this year. You know, obviously, stock markets are a bunch of red ink, bond markets a bunch of red ink. Obviously, we're getting a bunch of questions from clients, and it seems like all news is bad news. I mean, doesn't it? I mean, just no matter what happens, markets are going to take a good piece of news, twist it around, and drive the markets into the dirt. And, you know, everyone's kind of waiting for, when are we going to buy that dip? When is this all going to end? And inquiring minds want to know, but then, you know, it doesn't seem to happen. I mean, Sam, what's going on?
It's a unique kind of phenomenon, I think, in the market, how, you know, exactly what you said about being able to turn any news. I mean, there's two sides to pretty much every news story. We saw last week with hiking rates. Oh, it's great, they're not going to do 75. Oh, well, now it's bad, they're not going to do 75 because inflation's going to run hotter.
Yeah.
And that's always going to happen. And then the phenomenon I think you see when the market's bad is it turns a lot of long-term investors into short-term investors.
Yep.
And that's how things, you know, get worse and worse, and you talk about downtrends, and it's hard to break downtrends, and it's because of that. People who said they were long-term investors and were looking at companies with long histories of growth rates going forward to all of a sudden, what's going to happen this next week? Do I sell it this week kind of thing? And so it's that kind of makes it hard to get out of these kind of ruts.
What do y'all feel like? I mean, obviously dealing with clients and just in general, like, you know, someone's going to see you on the street and recognize you from this podcast and be like, hey, you know, I'm nervous about what's going on in the market. What should I do? Not that we give any advice on what someone should do with their own investments, but is there something that maybe people become so reactive that that's not beneficial to them? Is it better to hold on to that cash, buy in on these dips, and stop trying to perfectly time the market? Or would you say, like, to your point, that someone that's long-term becomes short-term because they're reactive? Well, knowing that this naturally is going to happen over time.
I think a broad thing that you can say that pretty much works for everybody is just stick to your plan. Mm-hmm. You know, I mean, that's one way to describe, you know, risk tolerance, asset allocation, all that stuff is what's something that you can stick to. I mean, at the end of the day, everyone wants the most returns they can do, but if that's not something you can stick to with that level of volatility, then that's not the plan for you. So I think that's the simplest way to answer it for something that works for everyone is stick to the plan you had and don't let yourself become one of those short-term investors.
Do you agree, John?
I would completely agree with that. You also have to cancel people that investing is a marathon. It's not a sprint. And, you know, it's hard for people to really accept that. When they see the markets fluctuating as wildly as it is, they don't want to lose their money. The thing is, that's the way investors have been since day one. And when you take a look at things and just, gee whiz, every time we've had market downturns, you know, just this time it's going to be different than the last time. Next thing you know, a couple years later, the market's going to higher highs and what have you. So it's hard to get that point across because people are emotional about their money, and they're more so about their investments than they are their deposit accounts. I've never talked to a single person that gets all anxious about their deposit accounts. However, put a little bit of money into the market, and people start losing sleep at night. That's what's important. You know, if you are taking so much risk that you can't sleep at night, that you are anxiously looking at the computer screen or at the app on your phone to see what your balances are, Sam, Courtney, I would say that person, that individual that's really worked up about it, is taking too much risk in their portfolio.
Yeah, but you know, some of the beauty of the market is that, I guess maybe not the beauty of it, but that you do have trouble sleeping at night. I mean, there has to be some sort of risk involved. You know, if there was no risk involved and everyone slept great at night with all their money in the stock market, there would pretty much be no return in the stock market. I mean, risk premium involves having some level of risk, and that's a hard part to avoid. And again, that's why, you know, sticking to a plan and having that risk tolerance and allocation that works for you long term, that's the way you need to figure out how to sleep at night.
I mean, kind of with your years of experience, would y'all say that you see clients being reactive as adding to the volatility of the market?
Well, of course. I mean, that's why you do have volatility in the markets, because those people are going back to talking about just risk and not being able to sleep at night. It's those people that are like freaking out. I can't watch this any longer. I can't lose any money. that's when they go in and sell. They tell their brokers or their financial advisors, just get me out. I can't stand this any longer. And it's when you get that level of emotional attachment to your investments, that's when people make bad decisions. And one time years ago, while I was here at Oakworth, a client asked me, what's the value in a financial advisor? And I said, quite simply, I said, X, I said, I'm going to keep you from making mistakes with your money. You're plenty bright on your own. However, I'm not emotionally attached to your money. And so that way, I'm not going to be making emotionally fueled decisions about when the market's going one way or the other. And so I'm an insurance policy for you. And so he bought that and said, you're absolutely right. So that's why I think it's very important for people to get that dispassionate sort of advisor or someone to help them out so they don't make those emotionally fueled decisions. But fortunately enough, and Sam's absolutely right, fortunately enough for us, there are plenty of people out there freaking out, selling, and selling can't appreciate the risk that they're taking, and that gives us opportunities to create value for our clients and to make money in the long run.
That problem is, in the current market, it is dissecting different things going down. I don't think anybody here would argue that there isn't some things that probably needed to come down, some things that get overpriced in areas of different markets, whether it's crypto, some stock sectors, whatever have you. But a lot of times, and almost every time you get in any sort of pullback, you start to see the baby thrown out with the bathwater. And that is a consistent thing with any sort of pullback in the market, is this get rid of all you have or everything, and you're not really looking at what needs to be thrown out and what doesn't.
Yeah, so that's what's going on completely. And Courtney, I know that this was a topic that you had some interest in. What are some of the things that, when you're taking a look at the markets and when they're going up and down, how emotionally attached are you? What are you thinking?
Well, I think for me, my husband and I have kind of a set account that's money that we don't look at, kind of to your point. Like it's money that we've agreed that if it goes, it goes, but if we make money off of it, great. And so it's not a very large account, but it's when we do have cash built up, then we can buy. And so of course I am a little reactive when I see it's at year to date a low in the S&P, then I'll go ahead and just buy a spread on that, because I'm like, okay, well, I like to make sure that I have a hard time necessarily phasing into the market when I think it's at a high, which is just probably because I can't buy that many shares, right? So I'm not buying big spreads. I'm buying one or two shares of, an iShare, or if we do decide to buy an individual, security, I'm obviously not making a big dip in the market, but it's fun, and you hope that are knowledgeable enough about what to buy that it will go up. But kind of to your point that you already made, John, this isn't something that I plan to touch for 10 plus years. So I'm not trying to day trade or make a quick buck. That's not the type of investing that I would feel comfortable with. But I would also say that I'm risk averse.
This is kind of a human nature problem, though. You see the same thing with companies buying back their own stock. You'd think if anybody knows what a company's stock should be valued at, you'd think it'd be the people in the day-to-day, in the weeds, running the company. And what you often see is companies buying back their stock at the highs and quitting buying back their stock when it's at lows. And so it's a very, very, very hard thing for people to overcome. And I think those buybacks are just a great example of it. These are the people that should be confident. They're saying, our stock's undervalued. We know what we're doing. We know what it's worth. And yet when it's selling off with the whole market and maybe they're the baby getting thrown out, they quit buying back their stock often. So it's a extremely difficult thing to overcome, to not buy at the worst times and not buy at the best time.
And this particular market cycle has been very interesting, and that's a great way of describing being very, very frustrating. And the fact that, we had the blow off in January, which wasn't all that surprising. It was a little bit stronger than I think what we thought it was going to be, Sam. Have some seasonal factors there, large endowments and foundations and certain mutual funds rebalance, to push off whatever gains that they need to and all that stuff. But then February wasn't real good either, as people were worried about the Federal Reserve, and they were going to start raising rates and all that stuff. And my Lord, the world's going to stop revolving and spinning slowly down to die, all that stuff. Then March was okay after we got that, the first rate hike, and it turns out the sun didn't rise in the west the next day, and then it didn't. And then April was just so bad.
Not fun.
Just strangely bad. Where really all news was just bad news.
Yeah.
And then May hasn't been terribly much better, and it's really truly one of the weirder times that I've seen in my career with the markets behaving the way that they are, particularly when there's so much that looks okay. I mean, in 2008, all hell broke loose, but there was a reason why.
Right.
And, the data was just horrible. I mean, economic data was horrible.
I mean, brink of financial collapse.
Brink of financial collapse. Then we had 2020 when, hell, we're shutting down the economy and all that stuff, and the markets go south. This one, I'm kind of taking a look at things going, okay, money's been pretty easy the last several years. They're just put your money in and just watch it grow, and just multiplying like rabbits. And all of a sudden, here we are this year. A little bit of pullback makes sense, but it's the way the market's been pulling back.
Yeah.
That's been sort of kind of frustrating. It's kind of like this is all based on emotion, because when you take a step back and soberly look at all the economic data that's coming down the pike, take a look at the financial health of the country, you're going, okay, people aren't reading past the headlines. They're not delving into the data. They're making just emotionally fueled decisions. And as you've already said a couple times, throwing the baby out with the bathwater. So this is one of those ones where, again, I've been doing this a while. It's kind of strange in the fact just how emotional people seem to be behaving this go around.
Do you think, I know we've talked about it before with, the looming recession, whether or not we're in a recession, how bad it's going to be. We've talked in the past about how, 2020, 2021, individuals had more cash on hand than maybe in years prior. And do you think that people are less inclined to put it into the market or to take any risk? Maybe they are more emotional just due to what has gone on in the last 2-3 years, and they're not willing to make the risk. They don't want to put it into the market because they're worried about, I might need this money. What if I get laid off? What if it's the recession? And they're going back to the doomsday of 2008.
I think, kind of on a different note, I think one of the biggest drivers so far this year and what's kind of made it different is actually just overall fear and uncertainty. And I've been shocked, and I think you have too, John, with how many questions we've gotten about Russia and Ukraine.
Yeah.
Obviously that's a humanitarian issue. It's awful what's going on, but it doesn't have a big impact on the U.S. economy or the global economy outside of, obviously, energy, which is its own kind of beast. And
that's all we hear about on the news.
And every time we've spoke somewhere, it seems like half the questions are about how Russia and Ukraine is going to impact our economy, and this is coming from real estate agents, from people in sectors that shouldn't really be impacted by this. And so whether that's the issue itself, there seems to be a heightened level of uncertainty and fear that is driving a lot of this.
Yeah, Sam, I think I know exactly which presentation you're talking about, where I have a bunch of questions, and it's great when you get questions after you make a speech, but questions about, a lot about Ukraine and just various and sundry things that really don't have a huge impact on the local economy or even the national economy. But, I guess it does kind of, when people are asking those questions, you have to kind of just take a step back and go, okay, what are all the headlines? What is driving this fear? What is driving this psyche where we want to throw the baby out with the bathwater? And then when you take a look at our current news cycle, it's kind of hard to feel real positive about terribly much. And that's where I think that situation's coming about Ukraine and Russia. It seems we've been listening to it so much, it seems so horrible, but point to me some really good news where people are like just going, hey, this is fantastic, and it's hard pressed to find it. And so that's what I think is driving a huge chunk of this going on, because the data is actually okay.
Yeah.
We should not be seeing negative 10, 12, 13% on the stock market this year.
And even our own political environment seems to be reaching kind of a boiling point on a lot of issues. And there's, there's just so much friction, it seems like, going on with new bills being passed, bills being overturned, what have you. I mean, there's a lot of friction going on and a lot of angst going on, and that seems to...
Where's the protest going to be today?
Yeah.
Is that the new normal, though? Is that our new political scene? That we should just expect it to always be like this?
I mean, it seems to be trending that direction.
Yeah, it certainly does seem to be trending in that direction where the extremes are getting more extremes, and the middle is kind of too scared to talk up because you don't want to be crushed by either side.
Right.
The loud minority seems to be kind of a thing that's
I don't like it. I think we should do something about it, but we're obviously trending off the primary topic. Well, what do you do when the market's behaving like this? And again, it's the best thing you can do. Courtney, I know that you originally asked this question. It's the best thing that you can do, and it's impossible. Yeah, I mean, most of the best advice that you give people, they're just simply not going to follow it.
Right.
You know, don't
stay the course.
Yeah, don't stick your fork in the outlet. That's a hard one. You know?
Right. They want to so bad.
Whenever someone tells you not to do something, the impulse is to. I wasn't even thinking about it previously, but now I got to do it. Is to really not look at it. I mean, that's so tough. It's really tough for a lot. Not look at it. You know, Beth and I have a little. She probably doesn't even know that we have it. You know, we're set it up, and it's just automatic investing. Just boom, boom, boom. I look at that once a year when I'm doing my taxes. I go get the form. I go, hey, that's pretty neat. That's pretty cool. It's impossible for most people to do that. But that's the best thing you can possibly do. Is going what Sam was saying earlier. Have that long-term plan. Understand what your time horizon is, and don't sweat the small stuff. And that's, like I said, very difficult for most people to do. What do you think, Sam?
It's extremely difficult, and that's why markets are always going to be volatile and uncertain, and it's never going to be some perfectly smooth thing because there's always going to be players out there, whether it's market makers that are maybe taking a step back due to uncertainty, to individuals, to pension funds. I mean, that's kind of a hopeless wish to think everyone will.
And the thing is that too, it could be a topic for another time about passive investing and how people talk about passive investing. And what I was talking about doing is being completely passive.
Right.
And we have all these passive investment products, and people have said that's going to cut down the volatility in the market. Having all these iShares, which you have mentioned, spiders, all the Vanguard mutual funds, all that stuff. If everyone just puts it in there and doesn't get emotional about their money, we would see volatility in the market essentially drop to nothing and be very difficult to make money.
The problem is the few people who are left that are the price makers at that point.
Well, it's also people, while the product might be perfectly efficient, people are not perfectly efficient.
Right.
Yep.
And so there's always going to be someone, even if I've got a passive investment product, I'm actively focused on my money, and so I'm going to make bad decisions with that passive product, and there you have volatility in the market again.
And people play off that, and that's sometimes the winners in the market is that they might promote news that they know.
Yeah, people talk their own book.
Yeah,
of course, but it's
all the time.
It's kind of I don't know what the right answer is on that. Do you want someone who is saying something that they don't have their own money invested in, or do you want someone who is saying something that they have put their money where their mouth is? So it's kind of...
Well, I mean, Bill Gross, when he was, really the big bond king, was known for getting on the television and talking his book. And people would immediately go do whatever Bill was doing in their own portfolios, and it worked out brilliantly for him because prices are going up on the products he's on the tapes about. And that still goes on. I mean, he's not on the TV anywhere near as much. Hell, I don't even know if he's still alive.
I think he's in some lawsuits right now.
so it's that's a great thing about doing what we do for a living. Great thing about the markets is every time you say this time's different. Every time you say, hey, it's going to be like this for forever. You get a curveball like 2022, and all that means is we just have opportunity to make money for our clients down the road. You mentioned in 20 and 21, you have all people having all this cash on hand. That cash is still out there.
Yeah.
There's a ton of money sitting on the sidelines, ton of money going into money market mutual funds, ton of money in deposits, and eventually all that money's got to go somewhere. And that's why you don't freak out, you don't throw the baby out with the bathwater, and you play for the long game and treat investing as a marathon as opposed to a sprint. And when all that money comes crashing back in, you're going to be well positioned to take advantage of it.
I always say buy when there's blood in the streets.
They do.
They do.
It's-
I've
it's-
never heard that ever in my life.
You've never heard that.
Never heard that.
Well, now you have.
Yeah. I don't know if I like it.
That's not my quote.
Oh, guys, well, we always love to hear from you all. So if you have any comments or questions, please, by all means, let us know. You can always drop us a line at tradingperspectives@oakworth.com, or you can leave us a review on the podcast outlet of your choice. As always, if you're interested in reading more, hearing more of what we've got to say or how we think, please go to oakworth.com and take a look underneath the Thought Leadership tab for all kinds of exciting information. I think we've covered pretty much everything on this topic today, but going to give you guys another shot for the last words.
That's all I got.
That's it, John.
That's all I've got today, too. Y'all take care.